Hi, it's George, your certified mortgage underwriter, certified non-QM underwriter, and more underwriter. Currently, welcome to my channel where I go ahead and do reaction to other credit experts in the YouTube world to go ahead and clear up any misinformation that's out there and be able to make sure that the advice that they're giving is accurate and true. Because again, these people are telling you what's going to help you get approved and their guidance. And me as a person that has approved auto loans, personal loans, lines of credits, different type of mortgage homes, I understand what it takes to actually approve somebody and have looked at multiple different lenders' guidelines. So yeah, definitely welcome to my channel. It's gonna be fun, I promise. Not gonna keep a promise. Well, I'm not gonna say I promise that potential I won't keep. But anyway, if you're new to my channel, go ahead and like the video. Find out towards the end if you want to subscribe. Let's go ahead and jump right to it.
Comes to explaining how they structure these underwriting deals for self-employed, because it's completely different from a person that actually work, right?
Yeah, it's totally different.
Okay.
It's totally different.
Yeah, I'll break that down for us. So what is the four structures that you can use to get approved?
The four we want to use is going to be, we can use a regular 2-year of 1099s. Okay, we can use 1 year of your 1099s. We can use 12 months of bank statements, or we can use 24 months of bank statements. Okay. So those are the four different options.
Okay. So let's talk about the first option first. All right. How does that breaks down?
How the first one breaks down is that we look at say you call me and tell me you're self-employed, right? We run the application and we see you're self-employed. I look at your tax returns, your 1099s with all schedules and everything for the last 2 years, 2021, 2020 in this particular case, right? We look at line 31. That's the available income that you have left that you show that you made with your business, right? After all your write-offs and depreciation, things of that nature, right? Okay. So we look at line 31 plus depreciation.
What is line 31? Explain that to me. So you say you look at personal tax returns, you look at schedules, but where's line 31 on the schedule? Yeah, I will need some breakdown communication on that, but let's go ahead and continue, just because, I'm already lost. I don't know what line 31 is. If I'm looking at it from a perspective of someone that's not familiar with the mortgage industry, I am lost, because I know what it is, line 31, as an underwriter, but not the audience. But let's go ahead and continue.
We look at that for 1 year, and then we look at the same thing for the next year. We take those numbers, divide them by 24. We average them out because we're averaging out a 2-year period, correct? And whatever we use at that shows as your monthly gross income using those 2 years. Okay. We use those. That's how the 2-year works.
Okay.
All right. So you want to go into the 1 year one?
Yeah, let's go. Yeah, transition over.
Okay,
yeah.
and the 1 year one, how the 1 year one works is that we spoke of, is that if you've been in the same business for 5 years, that business for over 5 years, we can use 1 year of your returns for your income.
So I'm gonna stop you right there. So the difference between the 2 years of using your tax returns is you could be in business. You have to be in business for 2 years.
Yes.
And you can use a 1 year if you have been in business for 5 years.
Same business for 5 years. Okay. The same business. Self-employed in the same business for 5 years.
Okay, so you get an incentive for being in business longer, where you can use one tax return versus 2.
Because sometimes people write off a lot on the taxes and stuff, so they don't have a lot left, as far as the income is concerned. So sometimes they may have had a better year this year than last year, right? And so we use that 1 year for that. And then what we use is that they have to have a 43% maximum debt to income ratio, because we use what they call Freddie Mac underwriting versus Fannie Mae underwriting. So that's where that 5 year comes into play, and 43% debt to income ratio maximum to go that particular route. But it is a good option if you have more income 1 year than the year before.
Awesome. All right. So yeah, let's transition over to the third one.
Okay, cool. And the third option that we have here, what we call bank statement options. All right, 12 months bank statement. Say if you look at your taxes and I say, hey, Mr. Q, credit coach Q, business did well, but you wrote off a lot. Okay, well, hey man, my business is rolling. I have a lot of income coming in with this business. It is rolling great. I'll tell you what we can do. Give me your bank statement. So click look at 12 months of your business bank statements. I'm going to shoot those over to my investor. What they're going to do is they're going to average your deposits. Okay. Your 12 months of your deposits, take out anything that doesn't, pertain to your business expenses, your business deposits, right? Then they'll send me an email back saying, okay, here's what we have. Here's what we showed their income is for that month, for monthly gross income. That's what we set the sales price and everything of the home based upon that monthly gross income.
Man, that's awesome. That's awesome.
So that's the option for the 12.
Okay, so the first two options is for tax returns.
Tax returns, 1099 full tax returns, and our schedules.
Okay, so let's rewind and do a full recap, man. So, for the people in the back. Okay?
For the people in the back, man, I know I talk fast sometimes too, so I don't want to lose nobody.
Okay. So the first one is for bank statement. For tax returns.
Tax returns, 2 years.
2 years, and the second one is for tax returns 1 year.
1 year.
5 years in business.
Yes, sir.
And the third one is for bank statements 12 months, and they take your deposits into question.
Yes.
And they minus that from your DTI income coming in. Right?
Well, yeah, they look at the deposits, they determine which business deposits are, and they take out anything that's not business deposits, and so they come up with an average of that for your monthly gross income, based upon your 12 months of your business bank statements. Also, personal bank statements options. So they have business and personal options, just depend on the investor that I use.
Okay. What's the fourth one?
The fourth one is 24-month bank statement option. Like say, we have 2 years of the business, everything is working good, because say the 12 months doesn't give you enough income, so we go with 24-month bank statement option, and we look at that. And those are as low as 10% down options. So you can pay as little as 10% down to get those, to get those bank statement options. So they look at the 24-month, same premise as the 12-month, average them out, send me the email back, and then we go from there as far as your monthly gross income. And that's what we plug into the file and base your sales price of the home you need to be shopping for based upon this income that we've derived from these 12 or 24 months of bank statements.
Okay. So basically, you're saying that you have to be in business for 2 years, basically.
Yes.
You have to be in business for 2
to meet
years.
that 2 year time frame.
Okay. And with that being said, what is the best option out of the four?
The best option out of the four is that what fits your situation. You know what I mean? Though one of the cheaper rate would be the 2 year tax return option, or even the 1 year tax return option if you have enough income, because you can do regular Fannie Mae pricing. The 12-month and the 24-month bank statement that are options what we consider non-QM products, non-qualified mortgage, meaning that they're not sold through Fannie or Freddie Mac on the open market. So the rates are a little bit higher for those. You're not getting that premium rate, but it is an option when you need an option. You see, because you can always refinance later on down the line as business picks up, as you have those 2 years of the great income.
That's awesome.
You can go that particular route.
That's awesome. So let's do some fact questions. Okay. So what do you feel like is one of the biggest misconceptions of getting approved for a home loan? Like, what do you think is something that you feel like is one of the...
This video breaking down how to get approved for a loan based off self-employed was not executed properly. I personally think, in my opinion, again, as the expert here, that this wasn't explained properly. And I'm going to explain what I mean. So, in the finance or in the mortgage world, there are certain lingos that we use, and I think this is a mistake when you're talking to someone and you forget that you're talking to an audience. You have to be able to explain the lingo to people when it comes to certain words that are used that people are not familiar with. So one of them is, he said Freddie Mac. In your mind, you're like, is that a person? And I'll go ahead and explain who Freddie Mac is. So Freddie Mac is a corporation that is owned and backed by the government. The government went ahead and bought out Freddie Mac and Fannie. So they're the ones that go ahead and back the loan. So when mortgage company, banks, credit unions, other financial institutions give you a loan, they follow the guidelines of either Fannie or Freddie, depending on who they're gonna sell it to, since they're gonna be the ones to back the loan. and things of that nature. When you're speaking to people, you have to be able to break that information down because not a lot of people are familiar with it. Also, with non-QM, that's another lingo, and that's an abbreviation for non-qualified mortgage. Those are the ones that don't fall within Fannie or Freddie's guidelines. That is more for the lender, and they pretty much make up their own rules of how they're going to approve everybody that is asking for a loan. Investor is another one. Investor is just the lender, whoever you applied with. So that's one. Just being very being conscious of knowing that a lot of people may not know what these lingos are, and just making that aware to them. Two, he didn't go into the other self-employment incomes. You might be confused because, again, it's just depending on how you structured your business. So outside of the 1099 and the bank statements for self-employed people, he missed sole proprietor, which is just for a business that is for one person, which hence the name of the title, sole proprietor. When you are filing your personal taxes, your personal 1040s, a Schedule C is given to you for a person that is a sole proprietor in a business. So that is something that does end up coming with your personal tax returns when you're doing. He forgot to touch on what exactly that is. To me, I think that's what he's referring to, but I don't want to assume. I'm just trying to take my best guess, because on the Schedule C's of the 2019 tax returns, you do see line 31 that says the net profit after all the expenses. But again, he wasn't clear about that. The next self-employment that wasn't pointed out was a 1065 partnership. That's whenever there's two individuals that start a business. They'll file what's called a 1065 partnership, but this is not a personal tax return. This is a business tax return. And sometimes you will find this on the Schedule E Part 2. Right after the rental income on the personal tax returns, you'll be able to see other businesses listed on there, and then you'll know that you need to grab those business tax returns. Accompanied with the 1065 business tax returns, there's also K1s, which show you how they actually got paid through the business tax returns and whatnot. Another one that he forgot to go over was the 1120 S Corp, which is if you put a business in the LLC. It's very common to see LLCs file 1120 S Corp for their tax returns, and this is also a business tax return, not a personal. And that'll also come with a K1 showing you how each owner got paid, what's the percentage in the company. That is something that we look at to determine how much you made through the business. And then the last one that was missed was corporations, which I don't really run into a lot of corporations when it comes to self-employment. It's mostly just sole proprietor, partnership, and an S Corp that I run into. But those are the ones that were missing. And I'm really surprised the loan officer didn't mention it, because he was talking about Freddie Mac. So he should know if someone's self-employed. Like the 1099, I don't see personally as an underwriter. I don't see 1099 as often as I see someone that's a sole proprietor or an S Corp. Those are more common, more self-employments you do see, which is the majority of the people that do apply for a mortgage. They go the conventional route, which is through Fannie and Freddie Macs. And the people that he was talking about, we're the minority, the people that need to go through non-QM, because maybe the reasons why you would go through non-QM is bad credit, you've been through bankruptcy, if you're not a legal resident, if you don't have like an I-10, not an I-10, but a social, to be able to go through Freddie Freddie and Fannie. You can go through non-QM for that. The write-offs that he was talking about, sometimes people do write off a lot of loans, and their bank statement programs will help you because they'll just average out your bank statements with the deposits and through nothing that's, go through the calculations of averaging out how much you make. So the loan officer was definitely, he definitely gave a lot of good information. My thing is that it wasn't executed properly. He forgot to touch on the other self-employments that I went over, and then on top of that, I also give a little blame to the host. The host should have like a foundation of understanding what mortgage companies look for when it comes to self-employment. Because then he could have asked them those additional questions. Be like, hey, I've also heard of Schedule C. Are you really familiar with that? Or even before getting on camera, at least ask them, like, hey, what are the topics they're going to touch over? Oh, well, I was like, what about this one? So to me, great idea. Great idea, Credit Coach Q. It just wasn't as best executed as it can. If you definitely need somebody, you can always hit me up. Again, I've been doing underwriting for over 7 years now, and currently have experience within mortgage. I do the conventional through Freddie and Freddie Mac, and then I'm also doing non-QM loans. So I'm definitely equipped to answer a lot of these self-employment questions. But anyway, that's not why we're here. This is not why you guys came. You guys came because you wanted to hear my opinion, my expert opinion on this reaction to the video. But yeah, overall, it was okay information, just I think for the wrong audience. It was definitely for the minority as opposed to the majority. Hopefully another one can get better updated, but like, subscribe. See you guys on the next one. Have a good night.